the Fannie Mae and Freddie Mac said, you know what, we need to have a sort of like recipe that we use that's consistent so that when we lend money to the banks and then the banks lend money to the consumer, that everybody has the same adjustment based on risk tolerance. So think about it when you go in to get like your life insurance test. You have the nurse come to you and they take your blood and they ask you how much you weigh and they ask if you're a smoker or if you chew tobacco or how many drinks you have. They're asking you those questions because they're trying to figure out how risky of a client are you going to be to offer life insurance to you. That's what LLPAs are, but for mortgages. So it looks at actually 30 different components, things like what's your credit score, what's the credit history look like, how much of the home are you financing versus your down payment, what type of home is it? Is it a primary, second home, investment property? They deem a second home and investment property higher risk because if you were to default on a mortgage, it's probably going to be one of those versus your primary. Is it a condo or single family home? Literally, there's 30 different components, but the biggest two, of course, are the FICO score and the down payment. So I'm going to show you the changes that are being made. And the reason why you need to know this is because they don't make a lot of sense. Meaning you would think an 800 FICO score and 20% down is going to get the lowest rate adjustment because that's pretty low risk, right? That would make like logical sense. But no, Fannie and Freddie are just, quite frankly, not being super logical right now. So hopefully in the next few months, it's going to be like this for a while. I would expect it to be like this for most of the year, but they do these reassessments and hopefully enough people are like, this makes no sense and it shouldn't be like this. So what you need to know is who does it impact? Well, Fannie and Freddie are only backed for conventional mortgages. So people who are getting a conventional mortgage loan, this is who this impacts. People who are getting an FHA, VA, or USDA, those are not backed by Fannie and Freddie, they're backed by Ginnie. So that doesn't impact them. And even though this goes into effect May 1st, banks and lenders have already put it into their pricing because if you go out and you find a home, or if you're shopping for a home and we pre-qualify you for a home, but you don't end up closing until May 1st, then the banks get hit with this adjustment and they didn't charge the consumer for it. So most banks are already adopting to these rates. And this is the stuff that you don't see on the news and behind the curtain. So what is going on with these LLPAs? Well, let me show you guys. These are just two examples. You've got the FICO score listed here, and you've got the percent that you're financing on the top. So we think about down payment, like 5% down. 5% down means you're financing 95% of the home's worth. So if you had a 780 FICO score and you're financing 95%, you are going to get a rate adjustment of 0.625. Every lender, when they present you rates, already baked into that rate is this adjustment based on your risk tolerance. If you have a 700 FICO score and you're putting 20% down, you would be in this column here because you're financing 80% and you would actually have a credit. So you wouldn't be charged an assessment, you're deemed less risky. That's what that negative sign is. So this is what's interesting. If we were to look at the old chart versus the new chart based on just these two factors, what's crazy is that we didn't even have these top two tiers here. So before, if you had a 740 or above, you were in the top tier of credit. Well, now they've added two tiers. So now the top tier has changed and you have to be at a 780. That means if you're at a 760, you're in tier 2. If you're at a 740, you're now in tier 3. So here's where this impacts us, and where this doesn't make sense is now there are lower, everything here in green, there are lower adjustments. So a lower interest rate would be offered to somebody putting 5% down with a 780 FICO score than it was on the old chart. So now these people actually are getting better interest rates than before. But the people here in orange and red are getting worse rates than before this change. And it doesn't really make a whole lot of sense because look, these people all have great credit in here. They're putting either between 5 to like almost 20%. Like, why would they be getting worse? And that's kind of where every lender is scratching their head right now. And sometimes when Fannie and Freddie gets involved, they do things that don't really make a whole lot of logical sense. But it is important for you guys to know this, because what I see is a lot of consumers and even real estate agents typically go to a website called Mortgage Daily, and they're looking at interest rates. And it's not a bad website, but let me just walk you through this. You go to mortgage rates and you're like, okay, the 30-year fixed rate's around 6.75 or 6.78, 15 years 5.94. But here's the $1 million question. What adjustments are they using to average this? Are they using one that is looking at a 780 FICO score? Or are they looking at one that's a single family home versus a condo? What's this based off of? And then if you scroll down to the very bottom, which is what most people do, what they don't do, look how drastically different this is. So Mortgage News Daily is reporting their 30-year at 6.78. Freddie Mac is reporting at 6.32. And then the Mortgage Banker Association is pointing at 6.39. And they all claim, and look, here's points. So this one has points there, which means the more you pay points, the lower the rate is. It's a little bit deceiving. But this is why advertised interest rates don't tell you the full story, because you're not looking at all of the loan level price adjustments. And guys, all you have to do is come here to Google, type in LLPA, Fannie Mae. This is all public information. Fannie Mae. Here it is. This first one listed is loan level pricing adjustments. This is probably super nerdy, but it's really cool to me. So here's the new chart showing the FICO scores. So now the 740 or is a third tier. Here's the amount that you're financing. Now take a look at this bad boy. What if it's an investment property or a condo or a second home or your manufactured home? Look at these adjustments. So on a investment property or a second home now, it's a 3.375 rate adjustment with 20% down. And it's a lot less if you put 25% down. And so if you ask, well, what's the minimum down payment on an investment property? Well, it's 20%, but holy smokes, that interest rate is going to be ugly. But that's an added adjustment versus if you were buying a primary home, putting 20% down, you're not going to have that same level of adjustment. And this, again, is coming right from the banks. The other big difference that they added is this debt to income ratio. So now, if your debt to income ratio is over 40%, now there's another rate adjustment. And a lot of people have have debt to income ratios over 40%. So just to walk you through this, if they were 40% or 43%, we'd have to add 0.375. And let's say they were putting 5% down, we'd have to add this 0.125. That's just coming strictly, that's the fee that goes to Fannie Mae. And then what we do is shop the rates where we're shopping who's going to offer this loan for the cheapest. Wells Fargo, Chase, like what's their servicing fee? And that's what we're shopping. But we know this is baked into the rates from every lender based on these public adjustments. The other thing that they added, so this wasn't there before, this new change, they didn't care if you had a 48%, now there's this added adjustment. Even if you put 30% down, if your debt to income ratio is over 40%, you're gonna have that adjustment. And guess what, guys? Do you see that adjustment here? Nope, this is kind of like going to Zillow and looking up what the property value is for your home. It doesn't tell the whole story. Did you update the house recently? You know, it doesn't tell the whole story. So let's go back to this. There's also people who take out a second mortgage. So if someone buys a home at $900,000, they only want to put 5% down. That's entering into jumbo territory. The lender has to split the financing up into two mortgages. Now you have a first lien and a second lien. Look at these adjustments. Woo! 0.625. So people who take out second liens right now, the rate is a lot harder. Why do you need to know this? Well, if you're a real estate agent or you're a sales rep with a builder, you might hear gripings that their interest rate seems high based on what they're seeing on bankrate.com or mortgagesdaily.com. And you might even be like sitting at the closing table like, this rate seems high. Well, did they do two loans? Is it a second home or investment property? Now you can at least be more equipped to say, oh yeah, This year, they did make some changes when it comes to Fannie and Freddie, and you don't need to divulge all of this, but this is the why. It's because this is what's not advertised online, and it's specific to every single client. So sometimes a real estate agent will say, well, what's the average interest rates right now? And it's so hard to answer that because it's like, well, what's the FICO score? How much are they financing? You know, it can truly vary from client to client. But the biggest factor that causes rates to go up and down is not even this. It's what's going on with the bond market. And that's what I wanted to end with today. For your interest rate update and for our monthly market update, you guys know that I'm constantly monitoring the bond market, and